Forget the headline. Brent crude just surged over 9% in a single session, and almost every retail trader is about to do exactly the wrong thing. There is one danger zone and one hidden opportunity right now. I'll show you both. Look at your screen. The price ripped through the entire $75 to $82 range that had trapped the market for weeks, and now it's sitting at $83.01. On-screen text for the first 15 seconds reads, $83.01 trap, 2 scalps plus 1 swing. That number, 8301, is not random. It's the pivot where euphoria meets a massive liquidity void. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. Damn, why session bias is trending with a breakout continuation. But I am fading the first emotional spike. That means we only buy pullbacks into the newly established support. The single invalidation level that flips the whole structure bearish is a daily close back below $81.50. Write this number down. $81.50. If we close below that, the entire breakout narrative dissolves, and we are heading straight back into the oversupply glut. Now here's what the herd doesn't see. The commitment of traders' data and early ETF flow proxies show that managed money was heavily short crude into this rally. That means we have a classic short squeeze architecture. When war headlines hit, the shorts get annihilated, and that forced buying is what stretches the tape 9% in a day. Your edge is understanding that the squeeze is mature, not starting, so the highest probability entries are after a deep, sharp intraday flush that reloads the squeeze. Let's walk the charts from the monthly down to the 60-minute, because the multi-timeframe alignment here is uncommonly clean. On the weekly, we have a strong buy signal. Price finally recaptured the 200-week moving average equivalent, but more importantly, it cleared the entire 2026 value area high at $82. That range, from 75 to 82, was the battlefield between war premium and oversupply. A weekly close above 82 turns that entire zone into support. The MACD on the weekly is still negative at -3.11, but it is curling sharply, and a bullish cross is just days away. This is the slow, heavy institutional money tipping its hand, drop to the daily. The daily trend is strong buy. We are above the 5-day MA at 78.46, the 10-day at 77.05, and critically, we are above the 200-day moving average at 82.43. This is the first daily close above the 200 in over a month. That line, 82.43, is now the floor for any pullback trade. The RSI on the daily is only 55.7. This is stunning. A 9% rally and we are not overbought. That tells you how deeply oversold this market was, and it leaves plenty of runway before momentum exhaustion. The ADX is 30. 9 and rising. Anything above 25 on a breakout confirms trend strength, and 39 is explosive. Now come down to the 4-hour. Strong buy again. Price is hugging the upper Bollinger Band, and the 20-period MA on the 4-hour is curling up steeply, acting as dynamic support around 81.40. The MACD here is about to give us the hidden divergence that most traders miss. Price has made a higher high above 83, but the MACD histogram has not yet exceeded the prior peak from 2 weeks ago. If this histogram flattens and price presses to 84.92 without a higher MACD high, we have a textbook bearish hidden divergence, a warning that the squeeze is losing internal energy, not a reason to short, but a reason to tighten stops. That's the danger zone on the 60-minute chart. The picture is still strong buy, but overbought on the stochastic at 56, and the CCI is screaming at 194. This is stretched. The immediate support sits at the old range high, 82.00, then the 200 MA on the 60-minute around 81.60. Resistance above is the 50-day MA on the daily chart at 84.92, and then the 100-day MA at 86.06. Those are your swing targets. The pivot point from the old daily range is 78.43, but that's irrelevant now. The new pivot is 82 even. Every pullback to that zone is a potential reload. Here's what most traders miss. The cross-asset linkage is screaming. Brent's 9% move is dragging the entire energy sector. XLE futures are up, crack spreads are widening, and crucially, The US dollar is flat today. An oil spike with a flat dollar means the move is supply-driven, not just a weak dollar reflation. That is pure geopolitical heartbeat. And Bitcoin, the risk asset shadow, is not confirming the panic. BTC is stable, which tells me this is a commodity-specific shock, not a broad risk-on melt-up. That narrowness makes the oil move more fragile but also more technical. The last 24 hours of news are the kindling. Reports of a significant supply disruption in a key transit choke point hit the wires, layered on top of escalating rhetoric. But here's the narrative web. The physical market is still oversupplied. OPEC plus spare capacity remains historically high, and yet futures ripped 9%. Why? Because algorithmic trading and dealer gamma flipped the moment we cleared 82. Options dealers who were short calls had to buy futures to hedge, amplifying the move. This is a financial squeeze layered on a geopolitical bid. The 1 to 2 week directional lean remains higher as long as the supply threat is active, but the exact event that would kill this rally is a verified de-escalation headline or an OPEC plus statement confirming a production increase. If either hits, the air pocket down to 80 is violent. Now, your second interaction trigger. Do you think Brent closes the week above 85? Comment yes or no right now. I'm tracking the community consensus. The gamma wall at 85 is enormous, so the answer matters for momentum. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1, the opening scalp, scalping, high probability. This is a pullback snipe using the 5-minute chart. The breakout just happened, so chasing the initial move is a rookie error. We wait for price to retest the 200-day moving average support, which now sits at 82.43. On the 5-minute chart, I want to see price tap the zone between 82.40 and 82.50 and print a clear bullish engulfing candle that closes back above the prior red candle's open. That engulfing close confirms that the dip buyers are absorbing the profit-taking. The exact trigger, entry long at 82.55, placing a hard stop loss at 82.20, just below the wick low. That's a 35-cent risk. Take profit 1 sits at 83.30, the prior session's value area high, giving you a clean 1 to 2 risk reward. If momentum extends, take profit 2 is at 83.95, just under the intraday liquidity cluster. This scalp is instantly void if the 5-minute candle closes below 82.40, because that would mean the 200 MA failed as support. On-screen graphic appears now. The opening SCLP entry, 82.55, 5M bullish engulfing after 82.40 to 82.50 tap, stop loss, 82. 20 take profit 1, 83.30 take profit 2, 83.95 risk, ear reward. 1:2.1 a 1:4.0 are scaled invalidation. Void if 5M candle closes below 82.40. Strategy 2, the liquidity grab, scalping, counter noise. Using the 15-minute chart, the breakout has left a stack of stop-loss orders from early shorts just below the old range high. Market makers love to engineer a false break to clear those stops before the real move. On the 15-minute chart, I am watching the zone at 81.70 to 81.80. If price spikes down, wicks below 81.80, and then within 1 or 2 15-minute candles recaptures 82 even, that's the grab. Entry long at the close of the 15-minute candle that reclaims 82.05. Stop loss goes below the manipulation wick at 81.60. Target is a fast scalp at the nearest intraday liquidity pool, 82.80. This trade requires fast execution. If the snapback doesn't happen immediately, you're out. The risk is 45 cents, the reward 75 cents, so it's a 1 to 1.7 R scalp. This setup is specifically designed to exploit the stop hunt, not the trend. After this strategy, I want to hear from you. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. On-screen trade card, the liquidity grab entry, 82.05, 15M close above 82.00 after fake break below 81.80, stop loss, 81.60 take profit 1. 82.80 risk, ear reward, 1:1.7 R invalidation, void if the 15M candle. That reclaims 82.00 closes back below 81.90. Strategy 3. The session swing, trend alignment. This is the trade that captures a multi-session move aligned with the daily and 4-hour trend. The bias is bullish continuation as long as the 81.50 daily close floor holds. I want to enter on a 4-hour close above the 50-day moving average, which is the key resistance at 84.92. A 4-hour close above that level confirms that the daily moving average structure has flipped from resistance to support and opens the door to the 100-day MA at 86.06. So the trigger, buy on a 4-hour candle close above 84.92, with a stop loss placed outside the daily structure at 82.30, just below the 200-day MA. That's a $2.62 risk, but the target is asymmetric. Conservative take profit 1 at 86.50, just before the 100-day MA, giving you a $1.58 reward, roughly 1 to 0.6 in raw terms, but we add a trailing stop rule. Once price reaches 85.70, move the stop to break even. The stretch target, take profit 2, is at 89 even, the top of the next volume profile node. The invalidation that would shift the medium-term outlook is a daily close below 81.50. If that happens, the swing is dead and we are back to range-bound trading. This trade is about patience. It might take 2 or 3 sessions to trigger, but it catches the bigger money. On-screen graphic, the session STRNG entry, 84.92, for H close above the 50-day MA, stop loss, 82.30 take profit 1, 86.50 take profit 2, 89.00 risk, reward, 1:0.6 to TP1, 1:1.6 to TP2, with trailing stop at 85.70, invalidation. Void if daily close below 81.50. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. No positions through high-impact news like OPEC statements or EIA inventory releases. Stops are non-negotiable. This is how you survive to trade the next big move. The single most critical level for the next session is 84.92, the 50-day moving average. A 4-hour close above it, and the monthly trend flips from neutral to outright bullish, targeting 86 and then 89. A rejection at 84.92 with a failed MACD confirmation, and we could see a swift mean reversion trade back to 82. Tomorrow, I'm watching the EIA crude inventory report and any shift in the war premium headlines. If that 84.92 level breaks, the whole monthly trend flips. I'll have the updated blueprint 24 hours from now. So hit the bell if you want the full breakdown on trading gold, Aussie dollar, Japanese yen, euro, and Bitcoin. The videos are live now. Tap the end screen. Then hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter before the institutions front-run you. Watch the S&P 500 liquidity tide video next to see why. Equities haven't panicked yet. That correlation disconnect is the real story.